Silver's 10-month run is almost unbroken. Why this matters now. 10 months. Almost every single month. Green. No headlines. No excitement. No crowd rushing in. And yet silver keeps moving. Quietly. Consistently. Doing something it almost never does. Because when a market refuses to break, while most people are still looking the other way, it usually means the real pressure is building underneath. This isn't about a rally. It's about a signal. The kind that shows up before recognition, before explanation, before most people realize they're late. Stay with me. Because what this streak is pointing to has very little to do with silver alone, and everything to do with what's shifting across the system. Welcome to my channel. Now, if you've been around long enough to see cycles repeat, to know that the biggest changes never announce themselves loudly, go ahead and subscribe. Not because it's exciting, but because experience teaches that the quiet warnings matter most. And tell me in the comments, where in the world are you watching from? Silver's price has done something that rarely happens in financial markets. Month after month, it has closed higher, building a run that is now approaching 10 consecutive green months. On the surface, this may look like just another rally. Prices rise, prices fall, and metals are known for volatility. But when analysts step back and look at the pattern rather than the headlines, the picture changes completely. In commodity markets, consistency is unusual. Most assets move in cycles of advance and retreat. Sharp gains are often followed by sharp corrections. Long, uninterrupted streaks are rare because commodities are sensitive to supply shocks, policy shifts, and economic slowdowns. Silver, in particular, has a long history of sudden spikes, followed by long periods of decline. That is why a near-unbroken 10-month run demands attention. The signal here is not speed. Silver has not exploded higher in a dramatic fashion. Instead, it has advanced steadily, absorbing negative news, tightening financial conditions, and shifting expectations without breaking its underlying structure. For institutional analysts, this kind of behavior is more important than rapid price gains. Speed can be driven by speculation. Persistence usually is not. What makes this streak more unusual is the environment in which it is happening. Financial markets today are filled with uncertainty. Interest rates remain restrictive. Growth expectations fluctuate. Credit conditions are tightening in several parts of the economy. In such an environment, most risk assets struggle to maintain momentum. Yet silver has continued to close higher month after month, quietly defying the broader tone. This is where many observers misinterpret what they are seeing. They focus on daily price swings or short-term pullbacks and conclude that nothing meaningful is happening. Institutions do not think this way. They study closing behavior over long periods. They look for evidence of accumulation rather than excitement. A long series of positive monthly closes suggests that demand is persistent and that selling pressure is being absorbed. Another important detail is what is missing from this rally. There is no visible surge of retail participation. Public interest remains muted. Media coverage is limited and often dismissive. This absence matters. Historically, the most powerful moves in commodities begin when few people are paying attention. By the time enthusiasm becomes widespread, much of the structural move has already occurred. For decision makers, this creates a dangerous gap between perception and reality. Many still view silver as a secondary asset, useful mainly for short-term trading or industrial demand cycles. They expect strength to fade quickly, as it has in the past. But markets change character before they change narrative. The streak suggests that silver may be entering a different phase. Long streaks act as confirmation mechanisms. Each additional positive close reinforces the idea that buyers are not reacting to news, but operating on longer-term considerations. Sellers, meanwhile, appear unwilling or unable to push prices lower for sustained periods. Over time, this imbalance reshapes expectations. Now, what once felt temporary begins to feel stable. Analysts who study historical market behavior know that regime shifts often begin this way. The early phase does not feel dramatic. It feels repetitive. Prices keep doing the same thing despite reasons they should not. This repetition gradually undermines old assumptions. Eventually, participants are forced to ask why the market is behaving differently. Silver's near 10-month run is creating that pressure. It challenges the assumption that silver cannot sustain strength without speculation. It challenges the idea that industrial metals must weaken during periods of economic uncertainty. And it challenges the belief that monetary metals move only in response to inflation headlines or currency shocks. The streak also carries psychological weight. Each green month reduces the credibility of bearish arguments. Traders who expected a reversal are forced to reassess. Long-term allocators who ignored silver begin to notice that it is no longer behaving like a purely cyclical asset. This does not happen all at once. It happens slowly, then suddenly. Importantly, the signal is not about predicting the next move. It is about recognizing a change in behavior. Markets communicate through patterns before they communicate through stories. The story always comes later. By the time it does, prices have already adjusted. For business leaders and young entrepreneurs, understanding this distinction is critical. Strategic decisions are rarely made at obvious turning points. They are made when evidence accumulates quietly. Silver's streak is one such piece of evidence. It does not guarantee outcomes, but it alters probabilities. History shows that when a commodity builds a long base of positive closes without public enthusiasm, it is often being accumulated by actors with longer time horizons. These actors do not need momentum. They need consistency. They do not chase headlines. They respond to structural signals. That is why the streak matters more than any single data point. It suggests that silver is being repriced gradually, not impulsively. And gradual repricing tends to persist longer than speculative bursts. The key risk at this stage is complacency. Many observers dismiss the streak because it lacks drama. They wait for a clear catalyst, a headline, or a crisis. But markets rarely provide such clarity in advance. They move first, explain later. Silver's near unbroken run is not a conclusion. It is an early chapter. It tells informed observers that something beneath the surface has changed. What that change leads to will depend on factors still unfolding. But the signal itself is already visible. Those who recognize it early gain time. Those who ignore it may still react later, but under less favorable conditions. In markets, time is often the most valuable advantage. If silver's long streak is the signal, then positioning is the warning hiding underneath it. This is where the story becomes uncomfortable for anyone relying on surface-level indicators. Because while silver has been closing green month after month, the group that normally amplifies such moves is almost completely absent. In most market rallies, price and participation rise together. As prices move higher, speculative traders increase exposure, momentum builds, and positioning becomes crowded. That is how bubbles form. This is not what is happening in silver. Instead, silver is rising while speculative positioning sits near historic lows. Data from futures markets shows that managed money positions in silver are at levels not seen in decades. These are the funds that typically chase trends, magnify volatility, and accelerate price moves once momentum is obvious. Their absence during a sustained rally is rare. It suggests that the market is moving without the fuel that normally drives explosive behavior. To experienced analysts, this creates tension. Markets are most fragile, not when everyone is positioned, but when almost no one is. In such conditions, even modest new demand can produce outsized effects. There's little resistance above price because few participants are already committed. When positioning is light and structure is strong, the market becomes sensitive. This sensitivity is what makes the current setup dangerous to underestimate. Silver's price has been advancing without the support of speculative leverage. That means selling pressure has been absorbed by buyers who are not dependent on short-term price moves. These buyers are patient, they do not exit quickly, and they do not announce themselves. This type of accumulation changes how a market behaves. Pullbacks become shallow. Volatility compresses upward rather than downward. Attempts to push price lower fail repeatedly, even when news appears unfavorable. Over time, this frustrates bearish positions and forces reassessment. What makes this moment more suspenseful is the asymmetry it creates. There is far more potential buying power waiting on the sidelines than selling pressure embedded in the market. When positioning is stretched long, upside is limited. When positioning is minimal, upside is unconstrained. This is not theory. It is observable market structure. In past cycles, silver has often moved in two phases. The first phase is quiet accumulation, marked by steady price behavior and low participation. The second phase begins when positioning catches up to price. That is when volatility expands, headlines appear, and the public becomes aware that something has changed. The current market appears to be deep into the first phase. What keeps many observers complacent is silver's reputation. It is often described as erratic, unreliable, or purely industrial. That reputation encourages short-term thinking. But markets with poor reputations often provide the clearest signals when their behavior shifts. The gap between expectation and reality creates opportunity. Analysts studying this setup are not asking whether silver can pull back. Pullbacks are normal and expected. They are asking why repeated pullbacks fail to break the structure. Each failed attempt reinforces the idea that demand is not reactive but structural. This leads to an uncomfortable conclusion. If silver can advance this far with participation at historic lows, what happens when participation returns? That question introduces suspense, because participation rarely returns gradually. It returns suddenly, often triggered by a small event that reframes perception. A data release, a policy comment, a correlated market move. The trigger itself is usually minor. The response is not. When momentum-driven capital enters a market that has already been structurally strengthened, it does not negotiate with price. It chases it. And because silver is a relatively small market compared to major asset classes, the chasing effect can be amplified. The danger for late observers is assuming that they will have time. Thinly positioned markets do not move in polite steps once attention arrives. They gap, they overshoot. They force decisions under pressure. This is why institutional analysts focus on positioning as much as price. Price tells them what has happened. Positioning tells them what can happen next. Right now, positioning is sending a message that contradicts complacent narratives. Another layer of suspense comes from what positioning reveals about psychology. Many traders have been conditioned by past silver rallies that failed. They remember sharp reversals and long declines. That memory keeps them cautious. But markets do not reward memory when structure changes. They punish it. Each additional green month without speculative participation increases the risk that consensus is wrong. It suggests that the market is being supported by actors with different incentives and longer horizons. Those actors do not require validation from price acceleration. They are building positions quietly. For business leaders and entrepreneurs, this matters because positioning extremes often precede regime changes. When few are positioned and many are skeptical, the cost of being wrong is asymmetric. Being early carries opportunity cost. Being late carries structural disadvantage. The suspense in this part of the story lies not in what is visible, but in what is missing. The absence of crowd behavior is itself information. It tells analysts that the move has not yet become self-reinforcing. And self-reinforcing moves, once they begin, are difficult to control. Silver's current setup resembles moments in history when markets shifted character without warning. Not because conditions changed overnight, but because recognition arrived all at once. The groundwork was laid quietly. Then the response cascaded. At this stage, the market is balanced on perception. It does not need everyone to agree. It only needs enough participants to realize that they are underexposed. That realization, when it comes, tends to spread faster than expected. This is why positioning matters more than sentiment surveys or headlines. It reveals vulnerability. And right now, silver's vulnerability is not to collapse, but to acceleration. The market has built a structure that few are prepared for. Whether they will be forced to respond depends not on belief, but on timing. And timing, once lost, cannot be recovered. Silver is often misunderstood because it does not fit neatly into a single category. It is not purely a monetary metal, and it is not just an industrial input. It sits in between. That position makes it difficult to analyze during stable periods, but during periods of transition, it becomes unusually revealing. To understand why the current silver setup matters, analysts stop looking at silver in isolation. They place it inside the broader system that surrounds it. And that system is changing. For decades, the global financial structure rewarded financial assets over physical ones. Capital flowed into equities, bonds, and complex instruments built on leverage and confidence. Physical commodities were treated as secondary. They were cyclical, replaceable, and often ignored. Silver lived in that shadow, valued more for its industrial use than its monetary history. That balance is beginning to shift. When systems become strained, the line between monetary assets and physical assets starts to blur. Confidence becomes harder to maintain. Promises become harder to price. In such environments, assets with real-world utility and long historical memory begin to behave differently. Silver is one of them. Unlike gold, which is held primarily as a reserve asset, silver is consumed. It is used in energy systems, electronics, medical applications, and infrastructure. Demand does not disappear when prices rise. In many cases, it increases. That creates tension between availability and necessity. At the same time, silver carries a monetary legacy. It has functioned as money for thousands of years. When trust in financial systems weakens, that legacy quietly reasserts itself. Silver begins to trade not just on supply and demand, but on perception of stability. This dual role is what makes silver dangerous to underestimate during periods of transition. Analysts watching the current environment see several pressures converging. Industrial demand remains strong due to long-term infrastructure and technology trends. Supply growth remains limited by mining constraints and declining ore grades. Monetary uncertainty increases the appeal of tangible assets. Each factor alone is manageable. Together, they change how silver behaves. The suspense comes from timing. These forces do not align often. When they do, silver tends to lag at first. It does not move early like gold. It waits, then it accelerates. History shows this pattern clearly. In previous monetary transitions, gold moved first as confidence shifted. Silver followed later, often more aggressively, once the shift became undeniable. By the time silver's role was widely discussed, prices had already adjusted sharply. That lag creates complacency. Observers assume silver will remain secondary because it always has. They forget that roles change when systems change. What makes the current moment more significant is that silver's industrial demand is not optional. Energy transition projects, electrical systems, and modern manufacturing rely on it. These are not speculative uses. They are structural. When monetary stress intersects with structural demand, price discovery becomes less forgiving. At the same time, silver's market is relatively small. It does not take massive capital flows to move price meaningfully. When allocation decisions shift even slightly, the impact can be amplified. This is why analysts describe silver as volatile. In reality, it is responsive. Responsiveness is not randomness. It is sensitivity to pressure. The broader system is sending mixed signals. Growth narratives continue, but debt expands. Technology promises productivity, but requires capital-intensive infrastructure. Monetary policy attempts balance, but credibility is questioned. These contradictions create uncertainty, and uncertainty tends to favor assets that do not rely on narrative alignment. Silver's recent behavior suggests it is beginning to reflect this uncertainty. What adds suspense is the disconnect between how silver is behaving and how it is being discussed. Mainstream analysis often treats silver's moves as noise or temporary correlation. Analysts focused on structure see something else. They see silver responding to stress that has not yet fully expressed itself elsewhere. This is how early signals often appear. They do not shout, they repeat. Month after month, silver closes higher. Pullbacks fail. Participation remains light. Demand persists. Each of these facts on its own seems unremarkable. Together, they form a pattern. That pattern suggests silver is being repriced not for current conditions, but for conditions that are approaching. For business leaders and entrepreneurs, this matters because silver touches multiple parts of the economy. It affects input costs, margins, investment decisions, and risk management. A shift in silver is rarely isolated. It often reflects deeper changes in how resources and capital are valued. Ignoring such signals does not make them disappear. It only delays recognition. The power of this moment lies in its subtlety. There is no single event forcing action. There is no crisis demanding attention. Instead, there is alignment. Industrial demand remains firm. Monetary uncertainty grows. Supply remains constrained. Price behavior remains persistent. When analysts see alignment like this, they do not ask whether silver will remain volatile. Volatility is assumed. They ask whether the role silver plays in the system is changing. That question carries weight because once roles change, markets do not revert easily. Perception adjusts, allocation follows, and by the time explanation becomes widespread, positioning has already shifted. Silver's current setup suggests it is moving from the margins toward the center of attention, not because sentiment demands it, but because the system does. The suspense is not about whether silver will move tomorrow. It is about how quickly recognition spreads once enough participants realize that silver is no longer behaving like it used to. That realization, when it arrives, tends to travel faster than expected, and when it does, markets do not pause to accommodate late understanding. The final stage of any market shift is not driven by new data. It is driven by recognition. This is the moment when patterns that were visible only to a few become difficult for many to ignore. Prices do not wait for permission at this stage. They respond to pressure. Silver now sits uncomfortably close to that moment. For months, the market has delivered the same message in quiet language. Positive closes, failed breakdowns, persistent demand, light participation. Each signal alone could be dismissed. Together, they form a record. And records, once established, force reassessment. The problem for many observers is that recognition rarely feels urgent until it is unavoidable. They wait for confirmation from headlines, from analysts, or from consensus. But consensus does not form at turning points. It forms after them. This delay is structural. Most frameworks used to analyze markets are backward-looking. They rely on past relationships and familiar behavior. When those relationships change, the tools lag behind reality. Silver's recent behavior challenges several long-held assumptions at once, which makes it easier to dismiss than to confront. One assumption is that silver cannot sustain strength without visible speculation. Another is that industrial metals must weaken when economic uncertainty rises. A third is that monetary stress shows itself first through dramatic events. None of these assumptions are holding. Instead, silver is behaving like an asset that is being repriced quietly, without narrative support. That is often how transitions begin. The suspense lies in what happens when recognition spreads. Once enough participants realize they are underexposed, behavior changes quickly. Allocation decisions that were postponed are revisited. Risk managers reassess assumptions. Traders who waited for pullbacks find that pullbacks no longer offer comfort. At that point, the market stops negotiating. Silver's relatively small size adds to this tension. Compared to major equity or bond markets, silver cannot absorb large flows without significant price movement. And when demand increases suddenly, supply does not respond. Mining cannot scale quickly. Inventories are limited. The adjustment occurs through price. This is why recognition phases are often volatile. The market is not becoming irrational. It is becoming efficient under new constraints. What many fail to appreciate is that recognition does not require universal agreement. It only requires enough capital to act. Once that threshold is crossed, prices adjust to ration access. Those who hesitated are forced to respond under worse conditions. This dynamic explains why late stages feel sudden. From the outside, it appears as if the market changed overnight. In reality, the groundwork was laid over many months. The change is in awareness, not structure. For business leaders and entrepreneurs, this moment carries practical implications. Silver is not just an investment. It is an input, a hedge, and a signal. Its movement can affect costs, margins, and planning assumptions. Ignoring it because it lacks drama is a strategic mistake. Another source of suspense comes from resistance. Even at this stage, counter-arguments remain. Some point to potential pullbacks, others argue that past rallies failed. These points are not wrong. Pullbacks will happen, volatility will persist, but resistance often weakens just before it disappears. Markets do not invalidate structural trends through corrections. They test conviction. Those tests remove weak positions and strengthen the base. Each test that fails to break the structure increases the likelihood that recognition will spread. Silver has passed several such tests already. The final risk for observers is misreading volatility as failure. Volatility is not a sign of weakness. It is a sign of transition. Assets that are being repriced rarely move smoothly. They adjust through bursts and pauses as the market recalibrates expectations. History supports this view. In past cycles, silver often appeared erratic just before major advances. The erratic behavior was not disorder. It was the market absorbing new information unevenly. The difference this time is context. The broader system shows signs of strain. Debt levels are high, policy choices are constrained, confidence is fragmented. In such environments, assets that combine physical necessity with monetary memory tend to behave differently. Silver sits precisely at that intersection. The final stage of the story is not about predicting exact prices or timelines. It is about understanding risk. The risk is not that silver corrects. The risk is that recognition accelerates faster than expected. When that happens, decision-making becomes reactive. Opportunities narrow, costs rise, flexibility declines. Those who paid attention to the streak, the positioning, and the system had time. Those who waited for comfort will still act, but under pressure. This is why the near unbroken 10-month run matters. It is not a victory lap. It is a warning. It tells observers that something has already changed, even if it has not yet been named. Markets do not announce transitions clearly. They reveal them through behavior. Silver has been speaking for months. The question now is not what silver will do next, but how many will recognize what it has already done. Because once recognition arrives, the market does not slow down to explain itself. It moves. And those moves tend to be remembered not for their speed, but for how obvious they seem in hindsight.